Did you ever notice how headlines can scream one thing while the real story is happening somewhere else entirely? From 2018 to 2020, it felt like the world was on the brink of an economic Cold War between the US and China. We saw tariffs slapped on hundreds of billions of dollars worth of goods. Political leaders stood in front of cameras talking tough, promising to protect their industries and rebalance trade. The news was filled with talk of strategic rivalry. The message was clear. This was a new, aggressive phase of competition. But if you followed the money, you'd see something totally different. During that exact same period, some of the biggest names in finance, firms like BlackRock, JPMorgan Chase, and Goldman Sachs, were quietly expanding their operations in China. U.S. investment into Chinese markets didn't just continue, it surged. In fact, 2020 was one of the biggest years ever for American capital flowing into China. So, what gives? On one hand, political tension was at an all-time high. On the other, financial ties were getting deeper. This might seem like a huge contradiction, but it's not if you understand how global finance really works. Markets don't run on daily headlines or political speeches. They run on structural incentives. Large investment firms manage trillions of dollars for pensions, insurance companies, and university endowments. Their job isn't to make political statements. It's to get the best possible return for their clients. Their decisions are driven by things like benchmark indices, diversification, and projected growth, not by who's shouting the loudest on the news. A perfect example happened in June 2018. The index provider MSCI started including more Chinese stocks, known as A shares, into its widely followed emerging markets index. Now, this might sound technical, but its effect is massive. Trillions of dollars in investment funds automatically track these indices. When the index changes, the money has to follow. It's a rule-based process, not a political one. So, while politicians were drawing lines in the sand, the plumbing of the financial system was pulling capital in the opposite direction. Understanding this difference is key. Political rhetoric frames relationships as a fight. Capital allocation reflects a calm, calculated bet on long-term growth and market access. This pattern isn't new. It's a cycle we've seen again and again throughout history when major economies are in transition. These cycles aren't secret conspiracies. They're just the natural patterns that emerge as economies grow, integrate, and compete. Think about it in 4 stages. First, a nation's financial system grows to support its expansion. Second, a boom in credit fuels economic development and global influence. Third, as the nation takes on more debt and obligations, structural pressures start to build. And fourth, a gradual rebalancing happens as other economies around the world catch up and grow. Let's rewind to Britain in the late 17th century. The creation of the Bank of England gave the government a powerful new tool to finance its wars and colonial expansion. Over the next 2 centuries, the British Empire stretched across the globe, and the pound sterling became the world's currency. But nothing lasts forever. By the late 19th and early 20th centuries, new industrial powerhouses like Germany and the United States were rising. Economic leadership began to diversify. Capital, always searching for the best return, started flowing towards these faster-growing markets, especially the US. This shift didn't happen overnight. It was a gradual process that unfolded over decades, driven by changes in productivity, industry, and global power. Or consider Germany after World War I. Crushed by war reparations and political chaos, the government resorted to printing massive amounts of money. The result was the infamous hyperinflation of 1923, which wiped out savings and tore society apart. To stabilize the economy, international agreements like the Dawes Plan brought in foreign capital. But when the Great Depression hit a few years later, that capital fled just as quickly. It wasn't a coordinated plot. It was investors around the world reevaluating risk. Now let's jump to 1944. As World War II was ending, Allied nations met at Bretton Woods to design a new global financial system. The US dollar was pegged to gold at $35 an ounce, and other currencies were pegged to the dollar. This system created stability and fueled decades of post-war growth. But by the late 1960s, the US was facing its own pressures. The costs of the Vietnam War and growing domestic spending strained the dollar-S link to gold. In 1971, President Nixon shocked the world by ending the dollar's convertibility to gold. By 1973, major currencies were floating freely. The dollar wasn't backed by gold anymore. It was backed by the sheer size and strength of the U.S. economy, its deep capital markets, and the world's continued demand for dollars. Since then, the price of gold has soared, but this isn't a sign of one single event. It's the result of decades of inflation, monetary expansion, and shifts in the global economy. So where does that leave us today? The United States currently has a very high level of public debt relative to its economy. The Federal Reserve massively expanded its balance sheet after the 2008 financial crisis, and again during the pandemic. These weren't random decisions. They were emergency policy responses to stabilize the financial system during major shocks. At the very same time, China has been gradually opening up its financial system. Its bond and stock markets are becoming more accessible to global investors. When a global asset manager looks at the world, they're not just looking at today's headlines. They're assessing long-term growth potential, currency movements, and regulatory changes. They see that political competition can exist side by side with economic interdependence. History teaches us that shifts in global economic leadership happen slowly over decades. A country having a lot of debt doesn't automatically mean it's going to collapse. And capital flowing to new markets doesn't mean the old system is being abandoned. Global finance is all about adaptation. Headlines capture the drama of the moment. Markets, on the other hand, reflect the quiet, long-term positioning for the future. The real story isn't about secret plots or hidden agendas. It's about incentives, risk management, and the slow, gradual transformation of a complex global system. These changes rarely announce themselves with a bang. They unfold quietly through regulatory tweaks, portfolio adjustments, and shifts in economic weight, long before they become the big story everyone is talking about. Understanding this helps explain why the world can seem so contradictory. Yes, because the loud political noise and the quiet flow of capital are often telling two very different stories. Thanks for watching. If you found this breakdown helpful, be sure to like this video and subscribe for more insights into how the world really works. See you next time.